We're doing really great. Now that we have learned more about stock returns and what stock indices are, it will be great to learn how to calculate their performance in Python. The libraries we import are the same as before, and the tickers we use are the ones of the S&P 500, NASDAQ, the German DAX, and the London Financial Times Stock Exchange, informally called FTSE. Observe how a hat is added before each ticker. This is to indicate we are dealing with market index data. If the German DAX symbol and the London's FTSE seem intuitive, for some reason GSPC refers to the S&P's 500, while IXIC will provide us NASDAQ data. They can be a bit more confusing, but after a while, you'll get used to these acronyms. All right? We are extracting data for the last 20 years, so the first value will be the 1st of January 1997. The first thing we can easily notice is that the values of indices are much higher with respect to the adjusted closing prices of the companies we saw earlier. However, that's natural, given that indices are baskets composed of many stocks. Okay, let's plot this data on a graph. As we did before, we will normalize it to 100 again. Let's interpret the chart for a while. Around the millennium, we observe a general rise of the indices value. This was because in the period between 1995 and 2001, there was a dot-com bubble, and the stock markets in industrialized countries like USA, UK, and Germany were boosted by a significant rise in the value of internet companies. Being composed primarily of tech companies, NASDAQ logically depicts best this trend. Relative to the other indices, in a certain period its performance declines abruptly. In the next few years, Germany manifests stability and growth. Of course, the global economic and financial crises of 2007-2008, as well as the sovereign debt crisis in 2011, reflect the picture accordingly. But, in the long term, observing the results from 1997 until today, we can say that overall, all indices perform very well, with only an occasional drop of the FTSE below the initial growth level. NASDAQ scores highest in certain periods, and its performance is connected to slightly sharper variations at times. The German market is the one that demonstrates real persistence and stability. Great! Let's support this analysis with a few numbers. We must calculate the indices' simple returns. The output of this cell shows namely the annual returns. Wonderful! We were reasoning correctly. All four numbers are positive. The implication is that the average of the companies listed under the four indices has provided investors with a positive rate of return over the past 2 decades. Moreover, if we wondered whether NASDAQ or S&P 500 produced better results, here's the answer. Apparently, at least for this time span, NASDAQ surpasses the S&P 500 easily. The S&P 500 comes in third actually, because the German DAX outperformed it. Finally, let's put the adjusted closing price of a company and compare its performance with one of the indices. Let's opt for Standard & Poor's once more, and then include Dow Jones Industrial Average. The latter is an index, which aggregates the prices of 30 major U.S.-listed companies and attributes to them equal weights. It is a good indicator of the trend in the American economic system. Right. We see the numbers in the 3 columns. They go from below 100 to more than 20,000 units. Does that frighten us? Not at all. We know what to do. We will normalize our data. And when we do that, we will be able to see that P&G did better for the past 10 years. This is how we can compare the performance of stocks and stock indices, the first type of analysis that you need to perform when analyzing the stock market. Are you excited? Good. The topics we will see next will become more and more interesting. Thanks for watching.